Hello, future enrolled agents. Welcome to Module 1.1 of our EA Exam Part 1 course, where we're diving into the critical topic of using prior year's tax returns. As tax professionals, prior returns are like a roadmap. They guide us in preparing accurate, compliant filings for the current year. Today, we'll focus on three key areas: comparing data with prior years, ensuring accuracy, and handling carryovers like capital losses and net operating losses. By the end of this 30-minute session, you'll understand how to leverage past returns to ace the EA exam and serve your clients effectively. Let's get started. Alright everyone, let's talk about something that's incredibly simple but absolutely essential in tax prep: reviewing the prior year return. So, why does it matter? Think of the prior return as your starting point. It's your quality control checklist. It helps us ensure that the new return is complete, accurate, and consistent. Let me break it down. First, we check personal data. We look at names, social security numbers, filing status, and dependents. Why? Because these don't always stay the same. Maybe the client got married, divorced, had a child, or a dependent aged out. If we don't catch that, the current return could be filed incorrectly. Next up, income. If you see a big change in wages or interest, say a $15,000 increase or a $10,000 drop, that's a red flag. It could mean a missing W-2 or maybe a Form 1099 didn't come in. So we compare income line by line. What was reported last year? What's here now? Does it make sense? We're looking at wages, interest, dividends, pensions, rental income, you name it. This line-by-line review helps us catch errors before the IRS does. Now let's talk about deductions and credits. If a taxpayer claimed $12,000 in mortgage interest last year, but this year it's only $2,000, we need to ask why. Did they pay off their mortgage? Sell the house? Same thing with retirement contributions or big charitable gifts. Any major jump or drop needs to be explained. And finally, carryovers. This is a big one. Prior year returns often contain worksheets that calculate things like capital loss carryovers or charitable contribution carryovers. These amounts roll into the current year. If you don't look at the prior return, you could miss them, and that's money left on the table for your client. By the way, this isn't just best practice. It's backed by IRS guidance. Publication 17 specifically tells us that prior year returns help us report accurately and claim everything the taxpayer is entitled to. So the bottom line is this: the prior year return isn't just old paperwork. It's a gold mine of information. It's the first thing you should look at before starting a new return. It keeps you organized, helps you catch mistakes, and ensures your client doesn't miss out on valuable deductions or credits. And yes, this is a tested topic on the EA exam, so know it well. Let's summarize why prior year returns are such a powerful tool when preparing the current return. In short, they act as a cross-check. They help us ensure the accuracy of this year's filing by giving us something solid to compare against. Let's break that down into 4 practical uses. Number 1. Accuracy checks. We start by comparing income items, wages, interest, dividends. Say last year's return showed $50,000 in wages. This year's W-2 shows $55,000. That $5,000 increase makes sense if the taxpayer got a raise, a promotion, or changed jobs. But what if it was less than last year, or missing altogether? That could mean a W-2 didn't arrive or a 1099 was forgotten. Comparing line by line gives us a built-in red flag system. Number 2. Biographical information. We also confirm all the basic info: taxpayer's name, social security number, address, filing status, and dependents. Why? Because life happens. If the taxpayer got married or divorced since last year, their filing status might change. If a dependent turned 19 or moved out, they might no longer qualify. We want to make sure this year's return reflects those life updates. Number 3. Itemized versus standard deduction. Look back at Schedule A. Did they itemize last year? Did they claim mortgage interest, SALT deductions, or charitable contributions? If so, ask yourself, is itemizing still worth it this year? Or has their situation changed enough that the standard deduction might be better? And on the flip side, if they used the standard deduction last year but now have big medical expenses or mortgage interest, they might be better off itemizing this year. The prior return gives you that comparison point. Number 4. Follow IRS guidance. Last point, and this one's critical for both the real world and the EA exam. Always refer to the latest IRS publications. Here's an example from Publication 525. If a taxpayer receives a state tax refund this year, but they deducted that state tax on last year's return, then the refund must be included in income this year. But how do you know if they deducted state tax last year? Easy, you check the prior return. That's how we avoid missing taxable items that might not be obvious. So remember, prior year returns aren't just for record keeping. They're a diagnostic tool. They help us catch errors, apply carryovers, and file the most accurate return possible. Ensuring accuracy in reporting. Next, let's focus on accuracy. Prior returns provide critical data to ensure correct reporting in the current year, especially for items like asset bases, depreciation, and carryovers. Accuracy is vital to avoid penalties or audits. For instance, when a client sells a stock in 2024, you need the cost basis, which might be reported on a 2023 or earlier Form 1099B or Schedule D. If the basis is incorrect, the capital gain or loss will be wrong, affecting the tax liability. Another example is depreciation for a rental property. If a client started depreciating a property in 2020, the 2023 return will show the accumulated depreciation. You must carry that forward correctly to 2024 using the same method, typically straight line for residential property, as per IRS Publication 946. Consistency in accounting methods is also key. If a client uses the cash method for their Schedule C business, switching to accrual without IRS approval via Form 3115 is a red flag. Prior returns confirm the method used. For the exam, expect questions asking you to verify bases or identify errors in carryover reporting. Always double-check prior returns to ensure accuracy. Before we dive into preparing a new tax return, there's one thing we must do first. Review the prior year return. Why? Because it gives us clues. It tells a story, and it helps us avoid mistakes that could cost the client money or trigger an IRS notice. Let's walk through the key elements you should always review before preparing a current year return. Number 1. Income sources. Start by comparing income line by line. Wages, interest, dividends, business income, rental income, retirement distributions, unemployment, you name it. If a client had $1,500 in dividends last year and it's zero this year, something might be missing. Maybe they closed the account, or maybe they forgot to bring in a 1099. Also look for new income types, especially things like 1099 NEC for self-employment. These often appear when a taxpayer picks up side work or starts freelancing. Any unexpected change deserves a closer look. Number 2. Deductions and adjustments. Next, look at the adjustments. These are things like educator expenses, ERA contributions, HSA deductions, and student loan interest. Ask yourself, did the client claim these last year? Are the limits or rules still the same? Here's a great example. IRS Publication 505 reminds us that paying 100% of last year's tax, or 110% if their AGI was over $150,000, can help the taxpayer avoid an underpayment penalty. That's called the safe harbor rule. We're literally using last year's tax to guide this year's withholding or estimated payments. Number 3. Itemized deductions. If the taxpayer itemized last year, go look at Schedule A. Did they deduct SALT taxes? If so, and they got a state tax refund this year, we may need to include that in income. Did they give large amounts to charity? If so, and some of those donations were disallowed due to AGI limits, there could be a carryover. IRS publication 526 tells us those carryovers can last up to 5 years, and you'll often find them on a worksheet attached to the return. Number 4. Tax credits. Take note of credits claimed last year, such as the child tax credit, education credits, or the saver's credit. Some credits, like the adoption credit or foreign tax credit, have carry-forward potential. Look for unused amounts on worksheets or Form 8839, Form 1116, or other backup forms. If carry-forwards exist, we apply them on this year's return according to the current rules. Number 5. Payments and refunds. And finally, check the payment section of last year's return. That's Form 1040 and Schedule 3. Did the client make estimated payments? Did they have an overpayment from last year that they applied to this year's taxes? If so, that overpayment becomes a payment on the current return. It's not just a note, it actually affects the bottom line. So what's the takeaway? Setting up a checklist like this means no stone is left unturned. But remember, tax law changes, and they affect what can and can't be carried forward. So always cross-check with the latest IRS publications, Pub. 505, 525, 526, whatever applies. Prior year returns are a gold mine. Use them wisely, and you'll file with confidence. Now let's talk about something that comes up a lot on both the EA exam and in real-life tax prep, carryovers. Carryovers happen when a taxpayer can't use a deduction or credit fully in 1 year, so it gets carried forward to use in future years. Knowing where to spot these on a prior year return is critical. Let's walk through the most common carryovers you'll see. Number 1. Capital loss carryovers. If a taxpayer has more capital losses than they're allowed to deduct in a single year, the excess carries forward. The IRS limits capital loss deductions to $3,000 per year against ordinary income, or $*$ 1,500 if married filing separately. Let's say in 2023, the taxpayer had a net capital loss of $5,000. They could only deduct $3,000, so the extra $2,000 carries over to 2024. In 2024, they can use that carryover to offset capital gains, or up to another $3,000 of ordinary income. Publication 550 includes a capital loss carryover worksheet that helps you track these amounts. Number 2. Charitable contribution carryovers. Charitable giving is subject to AGI limits, usually 60% of AGI for cash donations to public charities. So if someone donated $80,000 in 2023, but the deduction limit was $60,000, they don't lose that extra $20,000. It carries forward, typically for up to 5 years. Pub. 526 explains how this works. You'll often find the remaining carryover listed on a worksheet attached to the prior return. Number 3. Passive activity losses. Losses from passive activities, like rental properties or certain limited partnerships, are limited by the passive activity rules. If a taxpayer couldn't deduct all their passive losses in 2023, the unused portion is suspended and carried forward. You'll see this on Schedule E and Form 8582. These losses carry forward indefinitely, and they can only be used when the taxpayer has passive income or when they sell the activity that generated the loss. Number 4. Business credit carryovers. Let's say a taxpayer had business credits like the general business credit from Form 3800, but their tax liability was too low to use the full credit amount. The unused portion carries forward, usually for up to 20 years. You'll find these carryovers listed on Form 3800 or in its attached worksheet. In the current year, you apply the carry forward to reduce tax liability if eligible. Number 5. State and local tax refunds. Okay, this one's tricky. It's not technically a carryover, but it often gets missed. If a taxpayer itemized deductions last year and included state income taxes, then got a state refund the next year, that refund may be taxable. Pub. 525 spells this out. If salt was deducted last year, then any state refund received in 2024 should be included in income, but only if the deduction provided a tax benefit. Number 6. Other credit carryovers. And finally, there are other credits that can carry forward, like the adoption credit, which can carry forward for up to 5 years, and the foreign tax credit, which can carry for up to 10 years. You'll find those on Form 8839 and Form 1116, respectively. Always check these forms on the prior year return to see if any credit amounts are still available to apply. So to wrap this up, carryovers can have a big impact on this year's return, but only if you spot them on the prior year return and apply them correctly. Always check the relevant schedules, worksheets, and IRS publications, especially Pubs 525, 526, 550, and the instructions for Forms 300, 85, 82, 88, 39, and 1116. And remember, every carryover is an opportunity to save your client money. Alright class, let's take a closer look at this summary table. It shows us how key items from a prior year tax return, 2023 in this case, can affect the current year's return, which is 2024. We are going to walk through 4 example categories, line by line, and I'll explain how each carryover or change should be handled. Let's dive in. Row 1. Wages, Form 1040, Line 1. In 2023, the taxpayer earned $50,000. In 2024, they're earning $55,000. That's a $5,000 increase. Now what do we do with that? We verify the W-2 totals. Did they get a raise? A new job? A bonus? This increase is expected if their employment changed or they advanced in their role. We always double-check the source documents to confirm that number. Row 2. Net capital gain or loss, Schedule D. In 2023, there was a capital loss of $3,000. That's the maximum amount you can deduct against ordinary income in a single year. So that $3,000 loss was fully used. There's no carryover to 2024. Now in 2024, they've got a new capital loss of $2,000. And remember, we can deduct up to $3,000 again. So this entire $2,000 can be deducted on this year's return. Row 3. Charitable contributions, Schedule A. This one's a bit more nuanced. In 2023, the taxpayer donated $10,000 to qualified charities, but their AGI limit only allowed them to deduct $6,000. That means $4,000 had to be carried forward. In 2024, they donate again, this time $8,000, and the new AGI limit is $6,600. So what happens? First, they deduct as much of the current year donation as they can. $8,000 is over the limit, so we cap it at $6,600. But we can also apply some of the prior year carryover. In total, they may be able to claim the $8,000 plus a portion, up to $4,000 of that carryover, depending on the remaining AGI room. So it's really about layering this year's contributions with last year's excess, staying within the AGI limit. Row 4. State tax refund. Now for the state refund. In 2023, there was no state refund. But in 2024, the taxpayer received $1,200 from their 2023 state return. Here's the kicker. Did they deduct state and local taxes, also known as SALT, in 2023? If they did, then that $1,200 refund must be included in 2024 income. This is straight from IRS publication 525. Why? Because the deduction gave them a benefit last year, so the refund becomes taxable in the year it's received. So what does this table teach us? That reviewing prior year returns isn't optional, it's essential. You'll uncover changes, spot carryovers, and ensure accurate reporting. Whether it's a carryover loss, a charitable deduction that didn't fit last year, or a state refund sneaking into income, this is the kind of detail that separates a good preparer from a great one. And on the EA exam, These scenarios show up all the time. Master this chart, and you're a step closer to that passing score. Let's bring all this theory to life with a few practical examples. These will show you exactly how prior year information, when used correctly, can affect a current year return. We'll walk through 3 common cases: capital loss carryovers, charitable contribution limits, and the tax treatment of a state refund. Let's take them one at a time. Example number 1, capital loss carryover. Meet Jane. In 2023, she had a net capital loss of $5,000. But as we know, the IRS only lets her deduct $3,000 in 1 year. That leaves $2,000 to carry forward to 2024. Now in 2024, Jane has no new gains, but she does have a fresh $2,000 capital loss. So what do? We use that $2,000 carryover from last year to offset this year's income up to the $3,000 limit. That remaining loss gets used up entirely, and there's nothing left to carry forward to 2025. In a voiceover style teaching point, notice here on Schedule D that last year's loss of $5,000 was limited to $3,000, leaving $2,000 to carry forward. This year, we can deduct that remaining $2,000. Example number 2, charitable contribution carryover. Now let's look at Alan. In 2023, Alan donated $80,000 to qualified charities, but his AGI was $100,000. That means the 60% limit capped his deduction at $60,000, and the extra $20,000 carried forward to 2024. In 2024, Alan donates $50,000 again, and his AGI goes up to $110,000. That raises his 60% limit to $66,000. So how much of that $20,000 carryover can we use this year? Well, $66,000 minus his $50,000 current year donation gives us $16,000 of unused room. So we apply $16,000 of the carryover, and the remaining $4,000 rolls forward to 2025. We cite publication 526, which reminds us that carryovers are limited by AGI each year and must be categorized by type. Example number 3, state tax refund. Finally, let's check in with Maria. She itemized deductions in 2023 and claimed $2,000 in state taxes on Schedule A. In 2024, she receives a $1,200 state refund. Now the question is, does she include that in income? According to publication 525, the answer is yes, if she got a tax benefit from deducting that $2,000 last year. So by checking her 2023 return and confirming she itemized and deducted the state tax, we know that the $1,200 refund must be included in her 2024 income. We report that on Schedule 1, Line 1 of the 2024 Form 1040. Had we skipped that prior return review, we might have missed this income altogether. And that's a classic audit trigger. So what's the big takeaway? Prior year returns aren't just paperwork. They're a goldmine of data that can directly affect this year's numbers. From capital loss worksheets and charitable carryovers to passive activity losses and credit limits, the clues are all there. Always dig into last year's return to spot the story behind the numbers. And for the EA exam, these examples are exactly the kind of scenarios they love to test. Okay, everyone, let's lock in what we've learned with some review questions. These 6 questions will test your understanding of how and why we use prior year tax returns. I'll read each question, give you a few seconds to think, and then walk through the correct answer and why it matters. Let's get started. Question number 1. Comparing prior year's data. A taxpayer's 2023 Schedule C reported $40,000 in gross receipts from their consulting business. In 2024, they report only $10,000. When preparing the 2024 return, what should the enrolled agent do first? Option A. Assume the business closed and report no income. Option B. Compare the 2023 and 2024 returns to identify the reason for the decrease. Option C. File the 2024 return as is without reviewing prior years. Option D. Report an error to the IRS for the 2023 return. Correct answer is option B. Compare the 2023 and 2024 returns to identify the reason for the decrease. Comparing prior year's returns is a critical step in tax preparation to ensure consistency and accuracy, as emphasized in IRS Publication 17. A significant drop in income, like from $40,000 to $10,000, could indicate a business slowdown, a change in reporting, or an error. The enrolled agent should investigate by reviewing the 2023 return and discussing with the client to confirm the reason, avoiding assumptions, A. Filing without verification, C. Or prematurely reporting errors, D. This aligns with the EA exam's focus on due diligence. Question number 2. Ensuring accuracy. When preparing a 2024 tax return for a client who sold a rental property, the enrolled agent needs to calculate the gain. The property's basis and accumulated depreciation are found in which prior year's return? Option A. The year the property was purchased. Option B. The most recent year the property was reported, typically 2023. Option C. The year the depreciation method was changed. Option D. The year the property was placed in service. Correct answer is option B. The most recent year the property was reported, typically 2023. To calculate the gain on a 2024 property sale, the enrolled agent needs the adjusted basis, which includes the original cost minus accumulated depreciation. The most recent prior year's return, 2023, will show the accumulated depreciation to date, as reported on Schedule E or Form 4562, per IRS Publication 946. Option A is incorrect because the purchase year return lacks depreciation history. Option C is irrelevant unless a method change occurred, and D only provides the starting point, not cumulative depreciation. The exam tests accuracy in sourcing data from prior returns. Question number 3. Capital loss carryover. In 2023, a single taxpayer had a net capital loss of $8,000. They deducted $3,000 on their 2023 return. In 2024, they have $1,000 in capital gains and no other income. What is the capital loss carryover to 2025? Option A, $2,000. Option B, $4,000. Option C, $5,000. Option D, $8,000. Correct answer is option A, $2,000. Per IRS topic number 409, a single taxpayer can deduct up to $3,000 of net capital loss annually against ordinary income with excess carried forward indefinitely. In 2023, the taxpayer deducted $3,000 of the $8,000 loss, leaving a $5,000 carryover to 2024. In 2024, they offset the $1,000 gain with $1,000 of the carryover, leaving $4,000. They then deduct $3,000 against ordinary income, leaving $4,000 to $3,000 is equal to $1,000 carryover to 2025. This is reported on Schedule D and the Capital Loss Carryover Worksheet, Schedule D instructions. Options B, C, and D miscalculate the deductions. The exam often tests such calculations. Question number 4. Net operating loss, NOL, carryover. A taxpayer had a $40,000 NOL in 2023 from their Schedule C business. In 2024, they report $60,000 in taxable income before NOL deduction from the same business. How much NOL can be used in 2024? And what is carried forward to 2025? Option A. $40,000 used, $0 carried forward. Option B. $32,000 used, $8,000 carried forward. Option C. $48,000 used, $0 carried forward. Option D. $40,000 used, $20,000 carried forward. Correct answer is option A. $40,000 used, $0 carried forward. For NOLs generated after 2017, taxpayers can use the NOL to offset up to 80% of taxable income before NOL deduction and carry forward indefinitely with no carryback per IRS Publication 536. In 2024, 80% of $60,000 is $48,000. The taxpayer's $40,000 NOL is less than this limit, so they use the entire $40,000, reducing taxable income to $20,000 with $0 carried forward. Option C incorrectly applies the 80% limit as the NOL amount. Options B and D miscalculate the usable NOL. The exam tests NOL limits and carryover calculations reported on Form 172 and Form 1040, Schedule 1, Line 8A. Question number 5. Foreign tax credit carryover. In 2024, a taxpayer pays $7,000 in foreign taxes on foreign income, but their U.S. tax liability on that income is $5,000. What can they do with the excess foreign tax paid, and which form is used to report it? Option A. Carry back 2 years or forward 5 years, reported on Form 1040. Option B. Carry back 1 year or forward 10 years, reported on Form 1116. Option C. Claim as a deduction only, reported on Schedule A. Option D. No carryover allowed, reported on Form 1040. Correct answer is option B. Carry back 1 year or forward 10 years, reported on Form 1116. Per IRS Publication 514, if foreign taxes paid exceed the allowable foreign tax credit, the excess can be carried back 1 year via Form 1040-X or forward 10 years. In this case, the taxpayer claims a $5,000 credit in 2024 with $2,000 carried over, reported on Form 1116. Option A has incorrect carryover periods. Option C is wrong because the carryover is an option, not just a deduction. Option D is incorrect as carryovers are allowed. The exam tests knowledge of carryover rules and form usage. Question number 6. Use of prior year returns. In reviewing a prior year tax return for her client James, enrolled agent Monica discovered a substantial error in how James had reported a stock sale. The return was self-prepared, and the mistake led to a significant tax underpayment. Monica promptly informed James and recommended filing an amended return to fix the issue. James appreciated the guidance and requested Monica's assistance in preparing the amended return. Monica agreed to handle the correction for a fair fee. Which of the following best describes Monica's actions? Option A. Monica violated Circular 230 by agreeing to assist in correcting the error. Option B. Monica is required to report the error directly to the IRS. Option C. Monica acted ethically by informing James and offering to amend the return for a reasonable fee. Option D. Monica should not charge a fee for correcting a mistake on a return she did not prepare. Correct answer is option C. Monica acted ethically by informing James and offering to amend the return for a reasonable fee. According to Circular 230, if an enrolled agent becomes aware of an error or omission on a client's prior year return, they must promptly inform the client and advise them to correct it. Monica did so and ethically agreed to assist with the amended return for a reasonable fee. She is not required to report the issue directly to the IRS unless required by law, or if the client refuses to comply in a manner that warrants withdrawal from representation. Great work! If you nailed these 6 questions, you're in solid shape with Module 1.1. And even if you missed one, don't worry. Go back, review the examples and carryover rules, and focus especially on what shows up on the prior year return. That's your playbook for accuracy, and the EA exam loves testing it. Ready for the next module? Let's move on to taxpayer personal information. Alright, future EAs, before we wrap up this module, let me give you a few practical tips for tackling prior year return questions on the exam. These are high-yield areas, so pay attention. Number 1. Know your carryover rules cold. You'll see carryovers on the exam. Period. So here's what you must have memorized. Capital loss carryover, $3,000 per year. Charitable contribution carryover, 5 years. Passive activity losses, indefinite carry forward, until there's passive income or the asset is sold. Foreign tax credit carries forward 10 years and can be carried back 1 year. These numbers come up often in both multiple choice and simulation questions. Number 2. Use IRS publications wisely. You don't need to memorize every IRS publication, but you do need to know which ones to reference. Pub 17 is the general guide for individuals. Pub 505 explains estimated tax and safe harbor rules, very helpful for planning questions. Pub 525 tells you which refunds and recoveries are taxable, like when a state tax refund becomes income. These pubs give you the logic behind the rules, so when in doubt, check them. Number 3. Compare prior year numbers carefully. On simulations, you'll often be given data from a prior year return. Use it. Look at the carryover worksheets. If the question says there are capital loss carryover, pull Schedule D and trace it. The EA exam is testing not just what you know, but whether you catch the details. Number 4. Watch for credits and elections. Some exam cases will mention a taxpayer choosing to apply a refund forward to next year's taxes. That refund becomes a payment on the new return. You must apply it correctly. It's not just trivia, it changes the numbers. Number 5. Use shortcuts when you can. The exam doesn't always expect you to do full IRS worksheet calculations. Instead, know the limits and apply them. If a taxpayer has a $6,000 capital loss, you just apply $3,000 this year and carry the rest. That simple knowledge saves time and gives you points. Number 6. Stay calm and read carefully. Finally, and this is big, stay calm. Read every number and every label in the question. Look for keywords like carry forward, unused, elected, and look for forms like Schedule D, Form 3800, or adoption and foreign tax credit worksheets. If you slow down and read carefully, you'll often find the answer right in front of you. So that's your game plan. Know the carryover rules, use IRS pubs smartly, compare details, and stay cool under pressure. You've got this. And remember, prior year return questions aren't just about taxes, they're about attention to detail, which is exactly what the IRS expects from an enrolled agent. That's a wrap for Module 1.1. You now know how to use prior year's returns to compare data, ensure accuracy, and apply carryovers like capital losses, NOLs, and credits. These skills are not only crucial for the EA exam, but also for real-world tax preparation. Keep practicing, and you're on your way to becoming an enrolled agent. In our next module, we'll cover taxpayer personal information. See you there. Next up, Module 1.2 Taxpayer Personal Information.